Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of corporate mumbo jumbo. Today we're diving into the Federal Home Loan Bank of San Francisco's, or FHLB San Francisco's, annual report. Sounds dull, right? But stick with me because buried in this report is a story of a bank trying to stay afloat in a sea of economic weirdness, leadership shakeups, and some serious questions about the future of housing. First off, what is the Federal Home Loan Bank of San Francisco? They're not your typical bank with branches on every corner. They're more like a bank for banks. FHLB San Francisco provides loans, called advances, to member banks, credit unions, and other financial institutions in Arizona, California, and Nevada. These members then use that money to fund mortgages and other community development projects. The core mission here is to make sure there's enough money flowing to help people buy homes and to support economic development in their communities. They get their money by selling debt, called consolidated obligations, on the global market, and because they're seen as pretty safe, they can borrow at relatively low rates and pass those savings on to their members. Alright, let's get into it. The bank's profits took a hit this year. Net income, the actual profit, was $402 million, down from $539 million the previous year. That's a decrease of $137 million. What's the reason for such a big drop? Well, two main things: lower earnings on their loans and investments, and they spent more on programs to help the community. They actually spent more on helping the community. These charitable donations decreased their net income, so although they earned less in loans, they also put more into the community and the middle class. It's not all doom and gloom. They're still exceeding regulatory capital requirements. Think of this as their safety net, and they're above what's required. The bank is facing a bunch of risks. Natural disasters, health emergencies, geopolitical instability, you name it. Any of these things could throw a wrench in their operations. They're also worried about weaknesses in the housing and mortgage markets, which could reduce demand for their loans. Basically, if fewer people are buying houses, the bank's main business suffers. It's been hard to attract and retain skilled people. The financial world is competitive, and there's been a lot of turnover in senior management this past year. It looks like there have been increased rates of attrition among workers and management. Cybersecurity is another major headache. Attacks are becoming more common and sophisticated, and a breach could really mess things up. The Federal Housing Finance Agency, FHFA, which oversees these banks, is taking a closer look at the whole system. One of the actions is the FHL Bank System at 100 report. This is like a government agency giving its opinion, and those are always critical and a source of important regulatory changes. This report could lead to big changes in how the federal home loan banks operate, who they lend to, and what kind of community programs they run. It could really affect the financial conditions of the bank. The bank also has climate-related risk management, which could expand the nature and complexity of the business and require the bank to control, assess, and report. The California Climate Corporate Data Accountability Act requires more laws, regulations, and policies for the FHLB, which could expand the scope and complexity of issues and increase the cost of compliance. The bank is also facing more cyber threats. In response, the bank updated its information security strategy and works closely with its information security department. Despite recent changes, the bank believes it is currently well positioned to achieve its objectives. As of the end of 2024, the average employee has been at the bank for 8.1 years. Moving on to some standard disclosures, there were no legal proceedings that are expected to have a material effect on the bank's financial condition or results of operations. The board declared a quarterly cash dividend at an annualized rate of 8.75%. This rate is sustainable under current and projected earnings while maintaining appropriate levels of capital. This is a cash dividend that will amount to $63 million, expecting to be paid on March 11, 2025. Net interest income decreased because of lower balances of advances in short-term investments and higher costs of interest-bearing liabilities. This bank allocated $93 million for affordable housing and community investment programs, with $52 million towards affordable housing and $41 million toward voluntary initiatives. They're facing a concentration of advances with a single non-member, 20% of advances. This borrower is a non-member, so when these advances either mature or are prepaid, they cannot be replaced, which will adversely affect advance balances in the future. One FHL bank can be liable for another's debt. All FHL banks have joint and several liability, so the finance agency can require any FHL bank to repay the consolidated obligations. To close this portion of the analysis, these are some of the items affecting the bank's business operations and their ability or motivation to invest. These items have the potential to materially affect the bank's financial condition and operations. As for internal controls, management believes they maintained effective internal control over financial reporting. Now, what do I think of all of this? Well, the Federal Home Loan Bank of San Francisco is in a tough spot. The drop in profits, concentration of loans, and a changing regulatory environment all point to a bank under pressure. The strengths seem to be their still strong capital position and its commitment to affordable housing. It would be interesting to observe how those efforts are affected going forward. But there are a lot of challenges, and I think a potential risk would be some leadership changes, which could create more issues. It needs to focus on managing its risk, keeping costs down, and figuring out how to grow its member base again. Overall, this report paints a picture of a bank at a turning point. It needs to adapt to survive and continue fulfilling its mission of supporting housing and communities in the West. Thanks for watching. If you enjoyed, please subscribe, like, and comment.